Hi, welcome to Investors Guide on ET Now. Thanks for joining us on the show. We're going to answer some very interesting questions on today's show. We're going to help plan portfolios that we hope will also help with your portfolio. So grab a pen and paper and write down the email ID that's flashing at the bottom of your screen, because this is what we're doing over the next half hour. If you're a single woman living in a big city, you have to pay close attention to your finances. We'll help you plan out your future today. We'll also review the UTI Dividend Yield Fund, find out if that's the fund you should be investing, especially in markets like this. We also help an entrepreneur plan out his finances before he takes the big step of starting his own business. Alright, it's time for me to introduce Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who speaks exclusively to this show and this channel. Dhirendra, thank you so much for joining us on Investors Guide. Alright, let's move on to our portfolio versus portfolio segment. So there is a 35-year-old Roshni has written in. She tells us she's single and she plans to buy a home worth 40 lakh rupees. And she has an annual income of 11 lakh rupees. And she tells us she's invested in an LIC policy. She pays premium of 16,000 rupees a year. She also invested 5 lakh rupees in the stock market, which has now come down to 3 lakh rupees. She also has 3 lakh rupees in fixed deposit. Now, she's been putting some money away in mutual funds for the last 3 years, and she tells us she's not impressed with the performance of those funds because they're all giving her negative returns right now. So far, she's invested, by my calculations, about 4,63,000 rupees in these mutual funds altogether. Now, she sent us a list of those funds. There are a couple of mid-cap funds. There's Birla Sun Life Frontline Equity, ICICI Prudential Dynamic, Reliance Growth, ICICI Prudential Infrastructure, DSP BlackRock Equity, a couple of tax saver funds, and the Reliance Equity Fund. Now, she tells us most of these funds, since they're showing her losses, she wants to know if there's anything she should change in her fund selection, and if it's the right time for her to stop her SIPs. Now, obviously, just like Roshni, there'll be a lot of people who've invested in equity right now who are looking at this market, who are disappointed by what they see. They're considering stopping their SIPs. Would you say, first of all, stopping your SIP is a good idea at this point?
No, not at all. In fact, it is very important to keep investing through these times. You should consider pulling out, taking your money out, just in case, you are likely to need the money for consumption. You are close to your goal in a year's time. Then I would say that, if your money has gone down in value and you think that it is still enough for you to, or even if it is close to enough to actualizing your goal, then by all means take it out. But if your money is, you are unlikely to need it for a few years, I don't think this is a good time. In fact, it is very important to keep accumulating, keep investing through these lean times.
From your case in particular, Roshni, definitely you first need to start with a health insurance policy on top of the one that you're getting from your employer. Make sure you have individual health insurance. You need a life insurance cover if you have dependents, especially if you're taking a home loan, and if you have dependents, you need a life insurance cover as well. But then she's going to need 8 lakh rupees for the down payment of that home loan. And if you're looking at her portfolio right now, you said there are a couple of funds that could be weeded out. Could you give us the names of funds that you think that she can do without? Because she has some strong funds. She has Frontline Equity. She has BlackRock Equity. So which are the ones you think that she should knock out of this portfolio?
Yeah, I can actually outline the principles first. And, one is that keep away from thematic, keep away from, anything which is narrowly focused fund. So from that standpoint, Birla Midcap is a sell. Similarly, Reliance Growth is proving to be a fairly average and, below average performance. For that reason, I would recommend a sell on that. And ICICI Prudential Infrastructure, a thematic fund, I think, it's now testing patience. Likewise, if SBI Magnum tax gain is out of the lock-in period, then that is also clearly a sell. And the remaining funds, I think all the money which will be stopped, which will stop moving into the fund which she'll be selling, that money can go there. And I think they are fairly strong funds.
All right, Roshni, this is the advice you have to jot down right now. Remember, don't pull your money out of an equity fund unless that fund is a bad performer, like Dhirendra mentioned, a couple of funds that you can do without, or you need that money right now. So don't stop your equity investments right now. The second thing that you need to remember, life insurance and health insurance. And then again, like he said, stay away from specific funds that have specific sectoral exposure. Stay away from these really narrow mid-cap funds. Stick to the equity diversified funds. So you have two options. He told you which funds you can get rid of, or you can just go straight to our stable growth portfolio and invest in that portfolio as well. Good luck with those investments. You can write back to us if you need anything else. Let's move on now to our hold or sell segment. Well, then Brahma Karaturi has written in, he's 31 years old, he has an investment horizon of 5 years. He's taken a health cover, he tells us, and he also has a life cover right now, which he's taken from LIC and SBI. He wants to know if he should be investing in the FMCG sector fund. He also sent us a list of his investments. The first thing that worries me about his investments is that he has only a 5-year horizon. So, DSK BlackRock Micro Cap Fund for 5 years, does that make sense to him?
It's a fairly impressive fund, but if it's, aware of the kind of decline it can say, the volatility that comes with this fund, and one should be fairly, methodical when investing. This is not a kind of fund where you invest and you sleep over it.
The Franklin Templeton Blue Chip Fund is the next one on his list. This is a strong performer. Would you recommend he continue investing?
Yeah, it's a kind of fund, where you keep investing and you don't have to bother at all. And it is proving to be the finest large cap fund. And given that, one has 5-year time frame, blue chip should be a good part of one's portfolio.
The HDFC Top 200 Fund is the next one on his list today. Continue investing in this one as well?
Yes, another good fund. And of course, it's not a pure large cap fund like blue chip, but again, a fund which will be fairly inclined to large cap. Undoubtedly, this is worth holding and investing more.
The HSI Prudential Discovery Fund, that's a fund that you recommend quite often. Should he continue investing?
Yes, one should continue investing in this one as well. Once again, not like the micro cap fund, but here is a fund which will also which will be very depressed in a market that we have seen in recent past. And that is a time when, one should keep investing and one should have the patience to one should not get upset by big decline in the interim. And yes, this should prove to be fairly rewarding. It may not be as disappointing as the micro cap fund can get.
The IDFC Imperial Equity Fund. Now, this is a name we don't hear too often, but it's not a bad performer. It surprised us quite a bit in 2008 when it did quite well. Would you recommend you continue investing in this fund?
I would say that this is an average fund, and if one is looking at a classic blue chip. So from that standpoint, I would say that invest your money in HDFC Top 200, invest your money in Franklin Blue Chip, and where you already have your interest. So this one can do without, though it is not a disappointing fund.
All right, last two funds are tax savers. Now, this is our last year to invest in tax saver funds. So I'm going to take them together. The Fidelity Tax Advantage and the Sundaram Tax Saver Fund. Should you continue investing in them, Vinay?
Yes, both are reasonably good funds, and Fidelity Tax Saving Fund is, I would say that it is among the best. And what you said that this could be the last year may not be, because we haven't seen the bill coming through in this parliamentary session, and which was expected. So I really don't know that DTC is on its way to getting executed and be implemented from 1st of April. In case we don't see the bill in this session, it might be a tough call for it to expecting it to get in motion from 1st of April 2012.
All right, and finally, his last question: should he be investing in an FMCG sector fund right now? Would you recommend an FMCG, a sector fund at all? We know that you don't recommend that investors take those views, but FMCG, are you bullish on that sector? What would you recommend he do?
No, I think a great time to invest in FMCG was 2 years back, because one is looking at past performance and getting encouraged to invest in a sector fund like that. One should be investing, he should be investing in a FMCG fund if he thinks that his other funds don't have reasonable FMCG exposure, which I don't think is the case. His blue chip fund has FMCG exposure. His HDFC Top 200 has FMCG exposure, and FMCG as a sector on the whole is not underpriced or is not a store of potential gains at this point, as it has been in the past, which actually shows in the performance so far. So I think don't get guided by the past performance, and you have had good managers to manage your fund, and they are doing a good job. You can do without the FMCG fund.
Right, so Brahma, you don't need an FMCG fund right now. The funds you have in your portfolio will serve you well, because they all have FMCG exposure. And remember, it's a fund manager's job to get you that exposure at the right time. So we're going to come to a quick break. On the other side, Virendra is going to stay with us. We're talking about the UTI dividend yield fund.